Yeah, we are good to go now.
Yeah, hi sir. First of all, thanks for taking out time. So,
Thank you.
yeah. So to start with, sir, one question that he has is in terms of our room inventory. So what we understand, we have got close to 4,572 rooms, and out of that, 2,041 is in international. Then some are managed where we have a equity interest, and where other is a without equity interest, international and EIH associated. So in terms of this breakup, how would you break up in terms of leisure and corporates side?
I think the easier way to just go through is one of our analyst presentations, which we have done in the past. But roughly, majority of more than 50% of our inventory is in city locations. But if you really want a location by location breakup, then I'd advise you to just look up one of our analyst presentations of the past, and it's all given there.
Fair enough. We have the recent presentation, but okay. But I'll just maybe check with Rajiv.
Yeah, in case you don't have, then we can always share that information with you separately.
Yeah. So in terms of ARR hikes that we have seen over last 2 years, first thing is I wanted to understand how much is sustainable, and how has been the recent trends, and then there are some expectations of the corporate hikes, and how much it is what we are expecting in terms to fructify eventually. Though we have given some indication in the analyst call, the recent, but maybe just update will be helpful. So you're on mute.
Yeah, sorry. So if you look at India, for instance, and this is generally a sort of a hash total that I'm talking about, which means that if you look at all kinds of properties taken together, whether it's in the luxury segment or upscale segments, and just do a hash total of all average room rates, and compare it with, let's say, 1920, which was a normal year, then roughly about 22%. I mean, it's 22% higher in the current year YTD till date as compared to 2019. Now, obviously, when you break it up into the various kinds of properties, whether it's luxury, upscale, etc., then the variations are different. But to give you a ballpark, that is where we stand in terms of increased ARR.
And in the breakup of this, let's say 22% ARR, this will be in terms of corporate, how much that will be hike, or we are still to go in terms of the renewal of contracts?
No, renewal of contracts have already happened because the winter season has already kicked in. So it depends from corporate to corporate, and it can range anywhere between 5 to 7% to 15%.
So if I understand correctly, the 50% leisure inventory would have already seen, let's say 22%, in fact, more than that hikes, considering we have 50% leisure, and the balance 50%, which is city location. And if we assume that's more or less that's corporate, then we are talking about on that 50% average 8 to 9% kind of an ARR hikes.
Yeah, well, I didn't say 50% leisure. I said more than 50% is business, is city hotels.
Okay.
Again, I think if you really want to break it up, then you'll have to go company wise, and then because it's not the same. Let's say, for instance, if you look at EIH, it's different. If you look at EIH associated hotels, it's different. If you look at the managed properties, then those are entirely leisure. We have not a single city hotel which is purely managed and not equity held. So probably it'll be better if the question is broken up into the various segments. So I'll be accordingly able to answer it. But to give you a very ballpark, if I just take all the properties, whether their equity participation is there or not there, and I just total it all up, then anywhere between 50 to 60% would definitely come under our the city locations. So the weightage is higher in case of the city hotels in our group.
Got it. So in terms of our expansion, if you in the past, so we have been very conservative. We currently have a very strong balance sheet. But somehow we have never, in terms of scaling up the number of keys, number of rooms, maybe as the industry would have done much better in terms of capex and then growth. So what's our thought process on that side? And incrementally also for next 2 years, we have just one restaurant and one club that's coming, and then we have coming the next inventory is FY26 or 27. So just to understand the group thought process in terms of capex and how should we see from here on.
So since you have the last, analyst presentation that we had,
Yeah.
there was certain number of over the next 5 years. What are the plans that have fructified till date? Those had been mentioned in terms of how many number of properties is expected to come. But I think your question is more on the philosophy, which I will attempt to answer. So first and foremost, I think our company, our organization operates in a certain space, and we would like to retain our market share over that space. So really speaking, we would not like to get into the commodity market where it's only an addition of number of rooms. The reason for that is that firstly, it is our philosophy to operate only the luxury and upper upscale segments, and we don't see any reason to deviate from that. And the second reason is that even our current experience shows that really speaking, the revenue growth and the profitability growth is way higher in the upper upscale and the luxury segments than in the mid-market and the upper segments. Upscale segments. So therefore, we are very choosy about what we operate. And the reason why we are able to command a premium in ARR over generally over the industry in the country is because we believe that we have superior service levels, which we want to maintain. And if you look at it, then, on one hand, if you commoditize your product, it's not easy to then maintain the service levels that you want to maintain. So essentially, in a nutshell, to answer your question, I think it's important to understand that we operate in a niche segment, and we would like to continue in that segment. Our profitability will come from the same, kind of properties that we operate in. And we don't think our earnings per share or our return on equity going forward will be any less than what the industry is. In fact, it will be better.
So, sir, when we look at historical data and it's a really long-term data, maybe the EBITDA that we did in FY8 and the EBITDA that we do this year, in fact, it won't be much of a difference.
Will be a hugely different number. If you wait for another a month, our board meetings are slotted for the 10th of February. And if you look at the first 3 quarters, the EBITDA of the first 3 quarters will be radically different from what it was in 2019.
Okay, but so in terms of rooms addition, let's say maybe our rooms were very close to around, maybe Naveen would have the exact data, but we were at 1,500, 1,600 rooms maybe 10 years back.
No, you're right. The number of rooms addition has not been in the last decade, has not been significant, very significant, although there were some properties added. However, this is undergoing a change and there are properties which are getting added. We have already made an announcement in the last analyst call, and there will be more to come in the months and the quarters that follow. But having said that, what I'm trying to emphasize is that if you look at the growth in profitability that we are having, at least in the current year, and I would like to stick to the current year because the last 2 years were really not comparable years, and compare it with 1920, you would find that the kind of increase that we're looking at rates and the kind of occupancies that we are seeing now, or in a nutshell, the total overall profitability that we are seeing is due to the fact that we are able to maintain our service levels and we are able to command that premium. And what I'm trying to emphasize is that while our philosophy is not to compete with others in terms of number of rooms, I think in terms of overall profitability, we will still achieve a better result than that, is what I'm trying to say.
Yeah, fair enough, sir. So this in current year, we have two properties coming, one Club Mumbai and restaurant in Mumbai.
The club is already operational.
Club is operational. Okay. So let's say at the peak occupancy, what will be the just economics of this club will be?
Well, the club is a management contract. It's a bay club in BKC.
Yeah.
So it's not very significant in terms of numbers, but we really do not put out numbers of individual strategic initiatives. But it does show the intent of the group to look at diversified businesses and see where we are going. So I think one of the good things in the current year is to look at the fact that we've at least looked at, whether it's the cuckoo or whether it's the restaurant, which is due to come in the next few months, or the club. These are all businesses that we've not, really attempted our hand before. And the philosophy of the group is changing that whatever is niche will work into that. This club is also a similar concept. What we would also wait to see is how successful we are in managing these kind of businesses. And once we have, we are fully sure that we've got a handle over it, maybe there would be expansion plans around these. And as and when they happen, we will certainly inform all our investors and analysts.
So this is completely managed contract.
Yes.
And same with restaurant?
No, the restaurant is on a lease model. So it's been leased to us, and the entire profits will be for EIH minus the lease rental.
Okay. Okay. And this Geo Convention BKC, that management contract of, I think that kitchen and so this will be what, any numbers that you want to share? That
no, we are not managing the Geo Convention Center. So there are two projects in the Geo Convention Center that are due to be announced. They haven't been announced as yet, and therefore I am unable to speak on those.
Okay. Okay.
But for the moment, in the Geo Convention Center as well as the Geo World Center, there are the projects that we've already announced, which is one cafe, which is already operational for the last 1 year, one restaurant, and the club. The others, you'll have to wait for the announcement to come, because obviously these will be formal announcements.
Fair enough. So I'll take a pause and maybe Naveen will have a few questions and then I'll come back. Thank you.
Yeah, hi sir. Just on the follow-up on Abhinav's question on ARR. I'm just trying to understand whether, I think the data that you mentioned was up to, let's say, Q2 versus 2019. Just trying to understand both from, let's say, demand momentum as well as how ARRs are holding up for the coming times. Is the trend broadly likely to be similar?
So you're on mute.
I'm sorry. Yeah, can you hear me?
Yeah, we can now.
Yeah. So the numbers that, I mean, the ARR trends that I mentioned is basically it includes current trends as well. It's not just up to Q2. So without getting into specific numbers, because we are in a silent period,
Sure.
all I'm saying is, sorry, there's a lot of background noise, so I can't really hear.
I'm sorry. I'll go on mute.
So yeah, so these trends are essentially which are current trends. And for the moment, at least what we see for the rest of the year, these are holding good. And in fact, these have bettered from quarter to quarter. There was a slight sort of pause in the second quarter, but third quarter is really looking good. And therefore, we don't see any reason for this to go. But obviously, I would take that, say that with a pinch of salt, because with the new advisories, etc., coming in for COVID again, really one can't, crystal ball gaze. But as things are as at the moment, there doesn't seem to be any hold up on that.
Sorry, just trying to understand from CY23. I think at least in some of our key locations, there are significant events like G20 and World Cup, etc. So going to the next year, considering that we've already on a base of a very high ARR this year, Would you think that there is a possibility of further improvement, or typically because there might be bulk deals out there, this would actually be at a at a more attractive rate to some of the bulk class customers?
Well, IPL happens every year, by the way, so
Yes.
that's not an issue. And I think IPL has long gone by, so therefore all the months after that have been pretty, they have been holding up. And the good thing is that they have been holding up in cities as well. And bulk of our inventory, like I mentioned, is in city hotels. So apart from Bombay, which really saw higher numbers because of, IPL was one of the contributors, but we have great numbers in Delhi as well, at Delhi NCR, I would say. And there wasn't any IPL there. So I don't see any reason. I think there is a general buoyancy that we are noticing. And obviously these are reflective in the numbers. So you see that despite our exceptional items, etc., that are there on our financial statements, the numbers are still better than what we used to do in the normal years before.
So you share the optimism in terms of ARRs, but in terms of this, there has been a significant pent-up demand that we have seen. So from here on, let's say from the next year onwards, any if you have to say guess that what would be the other than the COVID that let's say that we just set aside, but in a normal scenario, do you think that this strong pent-up demands will continue to sustain, or you see that there will be some cool off and we may see some drop in occupancy?
Abhinav, frankly, I don't think anybody in the industry, and I've heard other, our friends in the industry, others also speaking. I don't think anybody is saying anymore that this is a pent-up demand, because all those terminologies of revenge travel, pent-up demand, etc., the period for that has long gone by. I don't think that the travel that we are seeing now, or the travel that we are seeing even in the airline industry, is anything to do with pent-up demand. So unless there's something catastrophic that happens again, there is no indication as of now to change our views to say that things are going to drop. We have nothing on the anvil right now to make us believe that the demand for hotel rooms will go down. And I may also add to that, there is, I think you should look at capacity as well. So because in the last 2 years, there's been literally no capacity addition, that really augurs also well for the next few years, because capacity building in hotel industry cannot happen overnight. So if projects are not already on, then it's unlikely that suddenly projects will come into the picture, at least in the space that we operate in, over the next few months or so. So overall, we don't see any reason why, unless there's kind of a black swan event or something where things go wrong, which we can't predict at the moment, we don't see anything going wrong here.
So, sir, why we ask? Because we have seen on some of the urban discretionary categories, we are seeing some slowdown. Maybe it's an apparels or other side. So that's why just trying to have your view on this. Is there anything that currently you are witnessing? Maybe cancellations?
No, you're right. We are keeping track of that too in case of other industries. But if you look at several others, maybe apparel is one, but there could be various reasons for that. Yeah. Which I would really not be able to answer. But if you look at general production, GDP growth, collection, GST collections, overall, there's a buoyancy that is there. So in fact, inflation was one of the concerns that everybody had. But really speaking, in India, it doesn't seem to have impacted that much. So really, as of now, we don't have anything. But of course, like you are tracking various sectors, we are also keeping a tab on that. Plus, you should also see that the travel that happens, especially corporate travel that happens in hotel industries, is not just from industries and corporates that are there. It could be a whole range of segments. For example, it could be embassies, government initiatives happening, construction happening across the country. It could be the legal lawyer segments where lawyers travel. So it's a host of other travel, and we don't see all of that momentum. Momentum, it takes a little time to pick up, but it cannot slow down all of a sudden. I mean, even if it has to taper, it will take some time. And as of now, we don't see any signals for that.
So in terms of just a few data points, what percentage will be the foreign travel in our, let's say, occupancy, and what
So
will
in a
be the
normal
managers?
year, it's
Yeah.
about 60-65% in a normal year. This year, I will not like to really immediately predict because of so many imponderables which are there, especially the fact that the international airline space opened up quite late. And even after that, there have been some restrictions. Again, as we speak, even today, there are some restrictions on inbound travel with the government mandating, the RT-PCR tests from 6 countries, even through transit flying for passengers flying into transit zones. So if these happen, then obviously international travel will be impacted. But going by the sort of bookings that we've seen or the interest that we've seen in various international conferences, we don't have any indication as of now that the foreign travel is going to come down. So next year, as of now, what we believe is going to be a normal year.
So this World Cup, Qatar World Cup, did it have some impact in terms of Middle East customers coming in?
Not really. I mean, Middle East, no, nothing. I mean, we did have some, I mean, every hotel, I think, or every company, I think, in this industry had some lost some manpower to Qatar, the country, but I don't think guests really, there was nothing much. In any case, people were not living in Qatar. I mean, they were staying around.
Yeah. So instead of coming to India, and then they are traveling to Qatar. So did we see some impact of this? That's it.
No, our numbers don't show anything like that.
Fair. And one more question before Naveen, is that in terms of capex, so what kind of an ideal debt to EBITDA, debt to equity, or capex as a percentage of free cash flow that we generate in a year, that that's some kind of a guiding post for us to look for capex going forward?
So, our overall guideline is we maintain a debt equity of 20%. And that is the threshold. We don't exceed that. In fact, as we speak, it will be lower than that. And till our projects really come in full flow, which is currently on, but in any capital expenditure, any project, the capital expenditure doesn't happen immediately. In the first year, only about 5 to 10% of the expenditure happens, if it's a 3-year project, for instance. And about 30 to 40% happens in the second year, and thereafter, barring the last 10-15%, the rest of it happens in the third year. That is how the cash flows happen. So I wouldn't really say that there's a benchmark that we have, because we have enough appetite to raise funds, both equity as well as debt. And we do have several projects which are under discussion, which includes mixed-use projects also. So really speaking, our debt levels will not go over the top. At least as things stand now, it will definitely not cross the 20% threshold that we have, unless there's a requirement. Based on that, you can, and given the fact the projects that we've announced, plus the projects that we're going to announce over the next few quarters, I think you can get a fair idea of what is the capex spend going to be. But if you're talking of general, regular capex, which is there, because we also do a lot of renovations from year on year, and that does produce a lot of incremental revenue as we speak. I mean, for instance, I'll tell you, over the last few months, in the Trident Nariman Point, the 10th to the 14th floors were renovated, and these have been put back into inventory, which was not really saleable inventory prior to this year. So that is an addition in inventory from that point of view. That's about 85 rooms. Now, likewise, those spends are roughly in the range of between 40 to 50 crore a year. And I don't want to project the current year's cash flows, because they'll be substantially different from what has been the case. So let's say in the previous years, if you were to see, let's say on a PBT of 200-250 crores and a depreciation of about 120 crores, the free cash flow would have been anywhere between 350 to 400 crores. This year, definitely it will be higher. So our capacity to expend more capex is not really constricted. It is more about choosing which projects we want to do. So at the moment, we don't have a constraint in terms of capex or capital for the purpose of financing our projects.
Yeah, thanks, sir. Naveen?
Yeah, so just on the subject of capex, can you just help us as to, what is the kind of phasing in terms of capex spends over the next 2 years and in absolute amount?
No, as I just mentioned that, really in the next 2 years, there is not going to be much outflow unless we, announce some of the projects which are currently under discussion. So therefore, whatever is the case, it is not going to be more than 20% of our equity. So at the moment. But then there are other things also which you must keep in mind is the fact that we have been looking at our non-core assets also. And in fact, one non-core asset we disposed last year. There's another one which has just completed, which was also announced. And there also the cash flows have come in. So really speaking, capex is not so much of a concern in our case, given the projects that we've announced.
Okay. And sir, with regards to typical renovations, any significant renovations that are likely in the next 12 to 18 months that you can call out?
Yes, there are quite a few actually. So one, of course, has been completed in Bombay, and these renovations, the major ones are in the Bombay properties. So there is a project of related to service departments at the Oberoi, Mumbai. So that is another important renovation where about 28 service apartments will be created. The mock-up has been completed already. And apart from that, there is a major renovation around the banquet at Trident Nariman Point. So these are the top ones. And then there are certain renovations which are on the anvil in some of our associate companies, associated and subsidiary company. So I'm not sure if your question relates to those as well. But if
it will help if there's anything significant to know, that will help if you cover
so
that.
Is in for renovation, definitely.
Okay.
There are some clearances which are awaited, but the moment those clearances come, Trident Jaipur will undergo a major renovation.
Okay. So then just from a thought process to understand how, these corporate rates land in terms of, how the pricing gets determined. Given that there has been some gap between the last negotiation and now, one would have assumed that, the pricing would, or the reset would be at a higher number. So I'm just trying to understand, given that, generally demand supply is tight, why isn't this number higher? I'm just trying to understand first, what is the thought behind it, or how should one think about it?
As I said, I won't say it's not higher because see, corporate business, any case is sort of a bulk business. So therefore it's not, and these are again for the lowest category rooms that I mentioned. So typically what happens is that although the base category rooms, the increase may range only from 5% to 15%, depending on the volume committed by corporates. If the occupancies are high, then rooms itself are not available in the first place. So then in any case, the regular bar rates kick in. And therefore, if you see the realization exactly is not in accordance with what rates have been shared with corporates over the counter, I mean, over the negotiation table, because they are not for all categories of rooms, and not always all base categories of rooms are available when they are, when the booking is happening. And also we've noticed that over the last several quarters now, there has been an increasing trend of corporates also, despite having a negotiated rate, also looking at the bar rate to see and check whether they are in tandem. But bar rates are generally higher. So therefore, but we do see bookings from corporates coming in through the OTA channels and our corporate website as well.
Sir, and you mentioned about, foreign travelers typically account for 60 to 65% of our, let's say, guest mix. In a way, given that, even outbound travel has been kind of restricted, do you think we've kind of benefited from that? And whenever, let's say the outbound aspect actually improves, there could be a potential impact?
See, it's a two-way thing, right? So if outbound improves, definitely inbound will also improve. And we've seen over the past 1 year at least that, when foreign travel was not there, even then we had, even our share of domestic travel also was not low. So therefore it was substantial and it was quite comparable. I mean, it may be that because of lesser number of hotels comparatively, we may have probably looked at lower numbers. But if you look at RevPAR positioning STR data, you will find that we are STR number 1 or number 2 in every city that we are located in. And when foreign travel was not happening, this was entirely domestic traffic. And now when domestic traffic really ventures out, by the way, it's already started. I mean, at least, for the last 2 months, I have been personally traveling internationally in a lot of locations. And I don't see any dearth of outbound travel. There's a lot of outbound travel happening already. So I don't see that affecting. Rather, one must also see that as a company, it really helps us in another way, because we have a large chunk of servicing international airlines from our catering service, from our Uber Air flight services. So that really, we have seen peak loads in the month of December, which has not been around for a very long time. So really speaking, I think for our group, it really augurs well.
So just on this catering business, how is that kind of overall faring, and what is the thought process here? Given that I think in the past, Jet was one of our key, anchors. How is that business likely to shape up over the next few years?
It's doing very well. In fact, it is doing better than our expectations. And I think, the thoughts around it is as very clear. I mean, there is obviously a lack of capacity given the growth that is happening. And there are substantial contracts that we have really won in the last few months also. So we are looking at a very positive, and healthy trend insofar as the flight catering is also concerned. In any case, we have a large share of international travel, and now with consolidation happening in the domestic arena, it is in the airline space, I'm saying, and given the fact that there are very limited players, it is imperative. If you do the equation, you will figure out that the capacity that is required domestically will be probably filled by one particular service provider, and therefore everything else is left for us to service.
Okay, understood.
And international travel any day is the rates, etc., are way higher than domestic travel.
That's right. So just any thoughts? Sorry, Abhinav, you have a question?
No, just on the international business side, how the things are looking.
You mean on international hotels?
Yeah, international hotels, yeah.
Yeah, the international hotels are doing well now, much better than what it was. The recovery in India obviously has been much better, but even locations like Bali and Marrakesh, Alzora and all of that are doing very well actually. So at the moment, there are no properties which are really complaining in terms of occupancy and ARR. Although in case of India, while India, the hotels have surpassed 1920 levels, although in case of international locations, it's not as if every location has surpassed them, but they're very close to what they were in 1920.
So in terms of profitability, how the international numbers are, margins, EBITDA level?
Margins are slightly lower than India because there are several cost elements which are higher there, including payroll. So if let's say in India, if typically a city or a leisure location does a EBITDA margin of, let's say, 55% or so, that will be probably around 40% in case of our comparable international hotels.
So in terms of ARR also, we have surpassed the last FY20 levels, FY19 levels in international, or we are still down there?
No, we have to look, location by location. Locations like Bali, etc., Bali Lombok, they are almost surpassing the levels. Locations like Marrakesh has to be seen differently because Marrakesh opened in December 2019, and shortly after that, the pandemic hit. So therefore, there is no comparable period, but especially in Marrakesh, rates as a city, the rates are very high. So rates are anywhere ranging between $600 to $800 a night. And we are definitely beneficiaries of that rate as well. Likewise, properties like Alzora, etc., are also doing well. Egypt is also doing well, so are Nile cruises, etc. So rates are very strong in international market generally.
So in the club Mumbai, what's our share, and in terms of what's the fees and then annual recurring fees, one-time fees that we are charging?
No, I mentioned that there is no share, meaning we don't have any equity there. It is a management contract, and there is a management.
So we get a fixed fees. Okay, we get the only fixed fees.
No, it's not fixed fees. It depends on on certain parameters, on the revenues as well, on the profits as well, that is generated from the various outlets, etc. So there are 7 outlets there, 7 restaurants, plus the club itself to be managed, sporting facilities and all of that. So there are arrangements which are there, obviously, which are between 2 parties, and therefore really it's difficult to discuss it on a public domain. But these are all management fees that are there, which are there on profits, and some of it on revenues as well.
Fair enough. Yeah, Naveen.
So any thoughts on where would we like to see our margins settle at? I think some of our peers guide towards a certain margin range. Where would we like to kind of directionally see our margins go towards?
We don't give a guidance, Naveen, unfortunately. But as I mentioned before that, we are very competitive, and our management is looking at things from a very different perspective. There is a lot of dynamism which has been there in the last few quarters, you would have seen. We are making announcements. We are a little more steady than probably others. But I think we are very firmly footed to achieve what is mentioned in our mission as to we want to exceed expectations of our shareholders.
Okay, just if you can speak on the cost side. I think some of the costs which we were hoping will remain, cost savings actually, which were likely to sustain, but I think some of it is coming back, at least for some of the peers coming back faster. So just any thoughts on that, if any areas one should kind of have a watch out towards, generally where inflation has been higher than what you would anticipate?
Sorry. So let me first tell you that, when I told you there was an ARR increase of 22%, and this is all trends that I'm talking about.
Yeah.
So in a comparable note, if revenues have increased in generally about between 25 to 27%, along with occupancy, compared to that, EBITDA has increased by over 50%. So therefore, that shows that the rest of it has come from, savings in costs. So I think what you are referring to is primarily on payroll, and we definitely had guided that we would have a 15% permanent savings. That has come down to some extent, but it is still there. So we still have about a 10% saving in overall payroll cost when we compare it to 19-20 levels or pre-COVID levels. And overall, our saving in fixed cost is also about 10%. So therefore, from that point of view, if you look at our fixed cost, typically used to be in a normal year. I'm not saying now because now the revenues are also higher, but it used to be around in the range of 700 odd crores. So 10% of that is definitely lower now.
So in our thought process, how do we think about owned versus managed? I think again, I'm taking from a playbook of another peer of yours who speaks very highly of an asset-light model, and that's the way to go, etc. Just your thought process. How do you think about it? Given that you actually operate in a segment which is slightly higher than this in a part of your business, so how should one think about that?
The first and foremost thing I would say that we are really glad in a company that our iconic properties, Uday Vilas, Vani Vilas, Raj Vilas, these were not management contracts. We are glad because we are really reaping the benefits of those investments that were done. So I think my personal view is that it is good to be asset light. Obviously, capital is not abundant. But I think there has to be a proper balance. And the concept of being asset light is nothing new worldwide. If you look at the 90s onwards, there has been a lot of consolidation in terms of owning the assets, and operating company having it differently. So while management contracts are important, I think for us, the philosophy is that we want to create each asset the way we want to manage it and operate it, and thereby make it profitable for ourselves as well as for our owners if we have to go for management contracts. And therefore, we are very choosy about what we do. We believe that by doing that, we will maintain the profitability automatically, because if the product is not built according to our designs, then servicing it or operating it and earning the same profitability is not possible. So therefore, that is our philosophy. Now, having said that, the question of management contracts really come in when there is a dearth of capital, right? In terms of there is a requirement of capital which exceeds what you really, the capital that you have exceeds or is less than what you require. So currently, as I said, that for the next 4 to 5 years, that is not the case. We don't see a scenario where we immediately need. So while we are in talks with several kind of property owners as well, who do have, we will do those management contracts only when it falls into the philosophy of the group. If it doesn't fall, then we are not in a hurry to really go ahead and sign up anything that comes our way. So I think from our point of view, it is more of a balanced approach. And while we do not feel, of course, cost of capital becomes much higher if you were to invest it and then generate it. And therefore, we are looking at other ways of handling it. For example, we are looking at mixed use projects also, as I said earlier. So we're going to balance it overall, but I don't think it is only asset light, that will survive and not the others.
I appreciate your thoughts, sir, but just that, what we've recognized is that generally there are cycles to any business, although let's hope and pray that this cycle remains longer than the previous cycles. The ability to obviously maximize your profits from a cycle is determined by, how many signups you can do potentially. That kind of fast tracks your profitability. So the thought was from that perspective. I appreciate that you're saying that, obviously there are a lot of factors to keep in mind, but I just wanted to know.
Your point is very valid. In fact, in an upcycle, it is the own properties that deliver profits, right? Because the bulk of the profits come to the owner come operator. But in a downturn, obviously it is again the same. It is a risk and reward story. So you are absolutely bang on without any question. But I'm saying that if a company's, if you may like to look at it this way, that if a company's balance sheet is not over leveraged, right, then what is the risk that is there? Really speaking, what is the risk that one is carrying? And I already stated that our debt equity philosophy is to hold it within 20%.
No, that's fair, sir. I'm just saying that basically between now and let's say your next significant point of inventory addition is a little far out. So from that perspective, there is a risk that, you might not see, a strong cycle at that point in time. So which is where my question was that, if there is a way to fast track this under management contracts, is that something that we would think about?
But even if it's a management contract, Naveen, it wouldn't fast track, because the point that I mentioned, that we don't buy brownfield projects or take brownfield projects. It has to be a greenfield project.
It has to
whether
be
it's a management
okay.
contract or others. But if you see, there are several properties, and please wait for more quarters. I'm sure there'll be more announcements that will really come, which are under discussion.
Okay. This last one, sir, is there any kind of further group level reorganization or restructuring that is potentially on the cards, or simplification, any of these factors, anything that we can expect?
I did mention about non-core assets, but
Okay.
we are evaluating non-core assets very, very closely. Of course, we have a lot of companies, and definitely there is more attention that is going to be given to our international locations, whether those need attention. I mean, so far they were not very actively handled from India, but going forward, the philosophy of the group is that there will be a lot more emphasis on that. I think one last point I'm really tempted to make still on your management contract question.
Sure.
See, a hotel management company has an X bandwidth, or a kind of bandwidth to manage an X number of hotels, right? So imagine that there is a runaway growth in the number of hotels that a company gets to operate. Will it be still able to maintain the same service level with the same bandwidth? Unlikely.
Unlikely.
Yeah. So I think that's one point which philosophically we are different from others. Sorry, sorry for belaboring that point.
That's fair, sir. Thank you.
Great.
Sorry. Go ahead, Abhinav.
One last, marriages, how much contribution that it does?
We don't track marriages separately, but MICE contributes about 5 to 6% of our overall business.
Okay. Yeah, I think that's all from our side, sir, and all the best. And we hope that this cycle continues so much longer that we have seen in the past.
We hope so too.
Thank you very much, sir.
Thanks a lot, sir.
Thank you so much. Thank you.
Thanks a lot, sir. Thanks, Naveen. Thanks, Abhinav.
Thank you.
Thank you, Rajiv. Rajiv, I'll let you know on whether, I'll speak with Lalit and then let you know.
Sure. Thanks, Naveen.